Okay, so from the notes, the argument centers on CleanSpark, specifically the big shift in institutional sentiment we're seeing.
Mm,
It's being driven by that JPMorgan upgrade, strong fundamentals, and, this major pivot into AI and HPC data centers.
right. And that framework is solid. You've got all the right pieces on the board.
So the question is how to make it all connect.
Exactly. How do we take these separate ideas, the JPM note, the massive earnings, the AI story, and weave them into one single, powerful narrative that a sophisticated reader can't ignore?
Agreed. And I think the best place to start is right there in the numbers, with the valuation.
Okay.
The material makes a really compelling case for bullish momentum, but it has to address that massive spread in price targets to establish a credible floor and ceiling.
This is it. This is where we need to embrace the complexity, not run from it.
Yeah.
The weakness, as it stands, is that you present these wildly different valuations almost as a list. You've got JPMorgan, very conservative, at $14.
Even after an overweight upgrade, yeah.
Right. And then it's sitting right next to the Wall Street average. What is it, around $23.50?
2357. And then you have HEC Wainwright all the way up at $30.
That's a $16 gap. It's huge. If you don't explain that, a smart reader's just going to dismiss the whole thing. They'll see JPM at 14 and think, well, why should I believe 30?
It just looks speculative. And that conservatism from a huge institution like JP Morgan, it can really kill the enthusiasm from the higher targets.
Mm-hmm.
So the suggestion here is to flip that. Use that divergence as your central analytical hook.
Okay.
Build a more sophisticated story that explains why. Why is JP Morgan so much more cautious than, say, PTIG at 26 or B. Riley at 25? This is where you go from just reporting numbers to really analyzing valuation models.
So instead of being shy about the $14 target, we lean right into it.
Exactly.
We ask the question, is JPM just using a standard Bitcoin miner multiple, which, is inherently more conservative?
While the others are already pricing in a forward-looking AI PEC multiple.
Exactly. If the reader understands that philosophical difference, the entire piece gets smarter.
It totally changes the conversation from what's the price to how is the price being calculated, which is a much more valuable insight.
Yeah.
So, for a concrete example, one way to do it is to frame JPM's $14 target not as a ceiling, but as a rock-solid, institutionally vetted valuation floor.
I like that. So 14 is the absolute worst-case scenario from the most conservative player.
Right. And by doing that, you actually make the upside to that $23 consensus feel much more credible and, frankly, achievable.
That's a very strong angle. What about the timing of the JPM note?
Good point.
We know the upgrade came right after that huge $1.15 billion convertible note offering.
Mm-hmm.
So another approach is to dig into that. Explicitly ask if JPM's conservatism is tied to them slapping a higher discount rate on the stock because of that financing event.
And you contrast that with the consensus, which is maybe looking past the short-term dilution risk and focusing on the future cash flow.
Right. You show that JPM is cautious for a specific financial reason. Suddenly, their $14 target isn't a dismissal of the bull case.
It's just a sign of their rigorous due diligence, which, ironically, makes the whole story stronger.
It really does. Okay, so now we've sort of reconciled the analyst views. But what's actually justifying those high-end valuations in the first place?
Well, it's the AI pivot, right?
It's the AI pivot. And that brings us to the second big opportunity here.
Yep. We have to really nail the more than a minor narrative. To justify that valuation, the material needs to explicitly connect the record-breaking financial success to the viability of that 200-megawatt AI expansion.
I see two separate thoughts right now in the material. There's thread A, which is the exciting AI catalyst, the 200 megawatts value that may be $13 million per megawatt if you look at tech comps.
Super exciting, yeah.
And then there's thread B, which is the incredible fundamentals, the revenue explosion of 102%, the $364 million net income turnaround.
Both great points.
But the weakness is that it stops there. It doesn't synthesize how that massive profitability actually funds and de-risks the new valuation. They feel like two good things happening at the same time, not one causing the other.
We have to make the profit the engine for the pivot.
Yes.
The suggestion is to leverage that fundamental strength. I mean, specifically the $364 million net income and that war chest of over 13,000 Bitcoin in cash.
Mm-hmm. Use that to prove that the company is ready to expand right now without desperately needing external funding. If the reader sees the expansion is self-financed, or at least de-risked by existing cash flow,
Then it's not speculative anymore.
exactly.
That change in perception is critical. When other miners talk about big expansion plans, the first thing the market thinks is, okay, how are they paying for this? Are they going to dilute us?
Right. Debt or dilution.
But this material has the perfect answer to that question, sitting right there in the financial statements. So why isn't that the headline?
It has to be. We need to shift the AI story from just a projection based on industry multiples to an operationally backed transition that's basically guaranteed by the cash they have on hand. So let's give some concrete ways to do that. First, you could strengthen that more than a minor idea by arguing that the realized profit lets them execute on the data center build-out immediately. Which makes that $13 million per megawatt valuation credible because they can self-fund. You could even do the math, show how many megawatts that net income could pay for each year.
That's very persuasive. And for a second point, we should link that massive revenue growth, that 102% jump, to their operational expertise.
Okay.
A growth rate like that isn't an accident. It proves they have the maturity and the scale to manage a complex 200-megawatt site in Texas.
So the track record validates the future plan?
It proves the AI pivot isn't just some promise in a slide deck. It's an actual, achievable plan.
You're showing the reader the foundation is already built for the next phase. I like it. Okay, so let's shift to the market mechanics, the final section, on the Sell the News event. That was very insightful.
Yeah, but I think we can take it a level deeper. The crucial sell the news warning about the after-hours dip should be elevated from just a simple caution to a sophisticated discussion on strategic accumulation around institutional entry points.
The weakness right now, I think, is that the diagnosis is correct, but it's a little surface level for this audience.
Right.
It correctly identifies the dip and calls it a classic sell the news event that shakes out the weak hands. That's all true, but it misses the chance to use that price action to reinforce the high-conviction institutional case that JPMorgan just laid out.
The suggestion is to frame that dip not just as random volatility, but as the perfect validation of the whole dip was the gift thesis. This gives real actionable context. It shows how institutions and, other smart traders use these little post-announcement drops as entry points.
It's the difference between just seeing volatility and explaining the opportunity inside the volatility.
Exactly.
And to do that, you have to connect the dip directly back to JPMorgan's own reasoning. They cited a valuation reset after the convertible note, so if the smart money just gave a thumbs up with an upgrade,
then any little dip that follows because of market noise becomes incredibly meaningful.
it suggests that the sophisticated players who are waiting to buy on the news were just handed a small discount by retail traders taking profits.
It's a classic arbitrage opportunity. So how do we make that super clear and actionable for the reader?
Well, for concrete steps, you could focus on the idea that the after-hours dip offers a second chance, a short-lived discount entry point for anyone who missed the bigger dip from the convertible note that JPM mentioned.
It's like a temporary market inefficiency.
Exactly. And even more powerfully, you can rephrase the whole point to be about institutional signaling.
Okay.
The buy ratings, like JPM's overweight, are basically a signal to the market that the fundamental value, that $766 million in revenue and $364 million in net income we just talked about, that it vastly outweighs the short-term noise from a sell the news event. The dip is proof the market is mispricing the news relative to the actual fundamentals. And by linking the trading action directly to the fundamentals and the institutional signal, you're showing a complete mastery of the story. You're integrating everything.
This has been a really productive breakdown. I think we found 3 critical areas to strengthen this material and really maximize its impact.
First, you absolutely have to resolve that massive divergence in analyst price targets. Use JPM's conservative $14 target as an analytical floor, not a ceiling, to explain the different valuation models being used.
Second, you've got to tighten that connection between the record earnings, that huge net income figure, and the AI valuation. Show how the company's financial strength de-risk the expansion because they can self-fund.
And third, leverage that sell the news dynamic. Don't just treat it as a warning.
turn it into a reinforcement of institutional conviction and a strategic opportunity for accumulation.
If you execute on those refinements, focusing on that internal logic,